Welcome to episode 60 of Running Greenleaf. Dave and Josh here. We're going through the nitty-gritty of operating investment real estate. Today, we are diving into kind of a third quarter wrap-up and review of where our commercial assets are and kind of what we're seeing performing in the market. So let's dig into it.
Yeah, so let's start with our strategy. Our primary focus is look for problems and find problems and ultimately fix those problems to hold for cash flow.
Yeah.
And really ride that cash flow for as long as it makes sense.
Yeah, pretty simple thesis, right? Like we want to go find problems in real estate. So anytime there's an asset class or an asset type or something where it's going into a situation where there could be some problems, we try and identify those and solve them. So a lot of what we cover and a lot of what we do is really trying to find things that were a problem and fix it. We did CAM. CAM was a big one when we were looking at buying leases or buying assets that had leases that didn't have CAM policies in place. So we went through and tried to fix that in a lot of cases, and we've been working through that right now. That's one of the strategies we did. But let's go into kind of what the transactions are and what we're seeing right now.
Yeah, so opportunistically, we hold our deals, we turn them around, we get them cash flowing, then we opportunistically look to sell them at their best value. So two of the deals we're selling right now, we bought about 18 months ago. They're fully occupied in Midtown Chattanooga. And we bought them, we're into them for about $80 a square foot, and we have contracts for around $130 a square foot. Great spread, great deal, and we're happy to exit them.
Yeah, our strategy there too is we're buying an asset where we had to get effective leases in place. We had to have, clean financials and a good operating track record. We can sell, these are couple million dollar deals. So volume's kind of dried up in a lot of places. But the couple $1 million deals, there's buyers out there right now. These things are transacting and happening. They're trading at good volumes. The buyer on this side is getting a good, solid cash flow deal at a pretty solid basis for occupied assets.
Mm-hmm. So. And then on the buy side, we're still primarily focused on this either industrial flex, where it's currently operating as industrial flex, and rents have risen so much over the last couple of years that we can buy an asset that's been operating where rents are, say, $6, $7 a square foot, but now the market's closer to $12 a square foot. So we can buy at a discount based on today's rents and turn them into, future rents that we're seeing.
Yeah. And within that, the problem there, an example would be our Davis deal, right? Like, we bought a flex deal. It is occupied. Rents are between $6 and $9 a square foot. There's not a lot of CAM in place on those, but the market is more 12 to 14-ish with reimbursements. So as those leases are coming up here, it's more a negotiation point of like, where are we going to be? How are we going to get more closer to market where things should be? And that's a problem, right? I mean, it's kind of a hard one to get through. Do you take a long-term lease? How do you work out the math of a discount and where you're at? So that's an exciting one we're going through and going to work through. But opportunities like that are really where we still see opportunities to buy stuff.
Yep. And we'll have that deal coming out next week. It's a smaller deal, about 35,000 square feet that we're buying for $100 a square foot, and fits right in our buy box, and we're excited about operating it.
Yeah, that'll be a good one too. But Davis, we've owned for a year though. Right. That one and it's similar, exact same kind of problem. Story. Right.
Yep.
So while you're not buying like at the absolute bottom of stuff, you're kind of in the middle because it's operating, it has cash flow, but that potential pops are there on what the leases look like. So, okay, let's go. It's the end of the third quarter. We want to touch base some on just distributions, right, as it portrays to our assets and what we're seeing in the market and how they're performing. So I think, with some of the other assets, we talked about themes of what's the theme that's working in generating distributions or the things that are holding us back.
Yep.
Right.
And so, when we bought these assets, we talked about CAM and really collecting that CAM. So CAM ends up being about 15% of our overall collections, about $2 to $4 a square foot, depending on the asset. And so collecting that CAM is a pretty big impact on on the revenue side. So the properties that are working have CAM collected. The properties that are not working as well, we're still in the process of collecting that CAM. Any property we've really bought over the last 24 months, it's taking some time to, number one, reconcile the CAM. Number two, communicate that CAM. And number three, work with that tenant either to collect it or to work out a payment plan, because it's a substantial amount of money for some of these tenants.
Right. This is 15% ish of their annual rent, and it was kind of a catch up from 2022 because we had bought some of this stuff, and CAM or reimbursements weren't necessarily being done, or they weren't clear to tenants on like, hey, how are these numbers calculated? So it takes a good amount of time. You're going in and showing a tenant every piece of the operating picture that's there, so they can understand it, so they can make it. Also helps them, conserve some of those costs and reduce them. It's really a shared benefit. If we can reduce CAM and their CAM can be lower, and our expenses can be lower, that's a win for both of us. So trying to do that as much as we can.
Yeah, one way we've done that in the past is put solar panels on the building to lower the overall electrical cost.
Yeah. Or we've gone around and done the LED light conversions, especially with like common area light poles and that kind of stuff, and reduce those utilities. So it's just cheaper. I mean, it's really a tenant benefit. It's cheaper. And if they're paying the utility costs, like we want to make it as efficient as possible for them to be there.
Yeah. And so the other recurring theme was similar to apartments. Is this theme of retention or controlling turnover is when we especially in our office properties, if we've seen a couple of our larger tenants ask for downsizing, whether it's 25%, 30%, 40%, or just a straight non-renewal. It's a pretty sizable impact to the upcoming downtime and future TI needs.
Yeah. And we have reserves, right? So we have cash. We want to be able to maintain our cash reserves and going through either a tenant changing location. I mean, we have some tenants that are literally moving buildings, which it works and we'll do with the tenant, but there's a cost of doing all that kind of stuff. So that's a little bit of like the, if things are working and we're seeing we've had clear CAM communications and those are coming in and they're paid and we didn't have any movement within the month, within the quarter really, then you're seeing good distributions. If we've got tenant movements on the commercial side, these are lengthier components, or if we have delays in CAM, that would prohibit us from distributions. And I assume that's the same for every other operator that's out there, right? Like those are kind of your big cost structures if you have those or you have a problem asset. So, okay, we should dive into CAM some too. Just kind of explain, what we're seeing, what our details are there. So CAM, just definition of CAM, common area maintenance. When we look at what falls into that, a lot of things in the commercial side are like, there's this version, there's the other version, there's the third version, there's all these different versions, and all the leases have been negotiated differently, independently, specific to a tenant. So we have about 2 million square feet of commercial space, and we have over 500 tenants. So our average tenant is about 4,000 square feet. So we've got a lot of them in all different, kind of configurations. But what falls into CAM in our story is a mix of everything from utilities and operating costs of utilities within the common areas, right? Cleaning, you're cleaning your common area if you have it. We don't have a whole ton of common area, but the stuff you have, it's got to be cleaned and maintained, and light fixtures have to work. So all the costs associated with that fall into there, and a lot of times also taxes and insurance fall into the reimbursement buckets too. And there's all sorts of different ways that can be divided up and split between an owner and a tenant. In some situations, a tenant is just paying utilities. Sometimes they're also paying taxes. Sometimes they're also paying insurance. And then a lot of times each one of those categories has different caps on the expense. The taxes might be, they can only go up 5% a year. Like they'll reimburse up to 5% increases each year, and the owner is going to eat that other increase on it. So you got to kind of match what you got to build a lease that matches what you think your cost structure is going to look like.
Right. And from a cash management standpoint, we have to receive these bills, we have to pay all these bills, and then we have to go ask for reimbursement. So from a cash management standpoint, you'll see big swings as especially the annual tax bill, right, comes in. Yeah. We pay that pretty monstrous bill, ends up being 20 to 30% of our overall expense hit. And we pay that bill, and then it takes months to break it down by building, by tenant, and then receive the reimbursement for that. Yeah.
And especially if there's changes each year, there's increases, right? I mean, all of our taxes here in the South are pretty much getting paid between September and November. You got some South Carolina stuff that's January, but it's really this fourth quarter coming up, which is where we see all of the tax payments. I think that's pretty standard. And then that will adjust our CAM reimbursements for next year. So example, you could say, just for easy numbers, if your tax bill is $12,000 for the year on our common area reimbursements. It'd be $1,000 a month for 12 months, and that would pay the $12,000 in taxes. But if taxes ended up being $14,000, hey, you're $2,000 short, and you're going to increase the monthly reimbursement for next year to recover what that looks like. So hopefully next year, if there are $14,000, you hit that, and it's a net wash on it. That's the goal, but it doesn't always work like that. You've got some back and forth, and that's a lot of communication with tenants on what is happening and why. But that communication is key. With that, you can have a successful relationship, with your tenants. If you don't have that, or you just don't communicate what's going on, it's going to be a challenge. Well, but leads to other problems and then opportunities for us.
Right, exactly.
So it's a mix.
Yep.
All right, you kind of coined this term, this flexify, which I like. Yeah. We're sitting around trying to figure out how do we, we're doing a lot of this stuff right now, and when we talk about it, people are like, what are we doing? And it's intriguing.
Yeah, so talking about solving a problem. So there's, everyone kind of knows what's going on in the market with office in general. Where we're really focused on is single-story office. Single-story office is actually performing fairly well from an occupancy level standpoint, but we're looking to flexify single-story office really throughout the Southeast, which is opportunistically buy the ones that are not doing as well. And a lot of them have had big tenant turnover, say 20 to 100,000 square feet turnover, and we can go in and break down that space into smaller suites, put some roll-up doors in, provide better access for trucks to access those roll-up doors, and flexify the space. And turn into industrial flex, which industrial flex is really just it's a fancy term for a tenant's unit that's roughly 70% warehouse, 30% office. Yeah.
And a lot of those types of assets, we've bought a bunch of these in the past few months here, and we see a good amount in the market, but it's a little specific to Atlanta. We haven't found it really outside of that market where you have like a 50,000 square foot single plate office with a boatload of surface parking. So you can easily do this. It can't be a packed in dense area. You've got to have room to add trucks or delivery into an area. And you got to have a pretty sizable floor plate that it makes sense to divide these spaces up.
Right. Yeah. So our recent Forum Flex that we closed, a couple of weeks ago, and then the Lakeside property that we closed in February are really the best examples of that. And we're in really Lakeside, the first 2 units should be online in the next couple of weeks. And Forum Flex, we start demo next week at our upcoming event.
Yeah. We've got an event coming up on the 25th. Mm-hmm. So a couple of days from now where we're going through what it looks like to demo one of these spaces and flexify it. It should be pretty darn cool, because just seeing all of the stuff that comes out really opens up the ceilings, look at the mechanicals. One of the benefits of the single-story office, converting it to this flex space, is that the office is heated and cooled. So now you have a heated and cooled almost warehouse space. We have 14-foot ceilings. You've got a big open expanse. So it works on that structure. So it's been easy to lease overall, and we're excited to do more of it. That's really the active problem that we are solving and doing this flexification.
Ooh.
Maybe that was what it's called, of space. And we look at our cost structure for that, and it always varies per asset, but we'll go into CapEx too in a little bit, but we've got a couple of these going right now. We're spending about $4 to $5 a square foot just to break down the space that's there. So that's getting rid of everything that's in it, opening up the ceilings. We're not raising them, so we're just opening up the ceilings. We have hanging LED lights that are in there. So that's $4 to $5 a square foot. And one of the Forum one we just bought had lots and lots of cubicles. So that added a couple bucks on the square foot, because we got a lot of stuff that has to come out of these offices.
Yeah, if you need any cubes, office furniture, desks, chairs, whiteboards, let us know. We have
dry erase markers. Yeah, it's like there's an endless supply of it.
Yeah,
and they really have they kind of have no value in the current market.
Yeah, we basically looked on Craigslist and Facebook Marketplace, and really just talked to some other office brokers, really to give it away, because it costs us money to demolition and throw it away. So maybe we just give it away for free, someone can pick it up. There's an endless supply of this stuff on the internet. So It's all in good condition and useful. It's just nobody.
Yeah, but there's no use.
Yeah, there's no
it's
use.
Useful, but there's no one that wants to use it.
Right.
So that can add a little bit on the cost structure. If you have a lot of stuff to get rid of, and then the next part is, in general, it costs us about $1 or $2 a square foot, where we can add in the roll-up doors and the outside access for trucks to get into these space. So, on the low end, we're talking like, 6 to 8 a square foot. And on the high end, we're maybe like 12 to 13, 14 a square foot, where we can run this business case and execute on that. So let's go through some CapEx. We got a lot of CapEx projects that we are doing right now, all tied to this flex outlay. And a lot of times we get asked, like, who's the tenant that goes into this thing? And it is a wide array of things. And I mentioned before, our average tenant has 4,000 square feet. Lots of different things can fit into that. We're currently negotiating some leases with like food truck vendors. We signed a sports company lease. We
did a golf simulator. We've had a brewery. We have a food prep place looking at some of our space. We've seen pet crematoriums in some of the space. There's
a lot of different businesses out there. So this space is very flexible. So you can kind of put whatever you want to put in there. And that's why we feel like it has pretty good demand. It's a space we like being in right now, and we're seeing the best value on that. So CapEx wise, the seven deals we have or so right now, we've got about 150,000 square feet that we are in the middle of converting to this flex asset. And all of these are the roughly 14-foot high ceilings, adding roll-up doors. Some of these we are literally just demoing where the office windows are and putting the roll-up doors there. One of these, it had the original roll-up doors in the ceiling still.
That was a huge win. Win.
That was our Lakeside deal.
Yeah.
We opened up the ceilings during our Flexify process, and they had the old roll-up doors in the ceiling, still plugged in, that we can turn on. They're still wired in place and go up right where the windows were. So it was more like a flex space that was turned into full office, and we're taking it back in that one. So that'll save us a little bit on cost there. Overall, it takes us about 3 or 4 months to get the demo permits and get the demo part done. And then it takes us a couple more months as we get the roll-up doors and everything permitted for the access hole on the outside of the building. So overall, it takes about 6 months to go turn one of these spaces around. And a lot goes into that time frame, especially if you look at some of these offices, we're removing power locations, internal wiring within walls. So, we've got to make sure our especially our electrical plan is lined up before we start knocking things down. I wonder what else we got on the CapEx front. We're kind of rocking and rolling with all these things that we have right now.
Yeah. Yeah, I mean, we're testing this out, on some of our office properties that we have some vacancy. We're testing out, converting some of the office to flex, like our Midtown property. We have a 10,000 square foot spot that it converts really easily. It used to have a roll up door, and so we took it was an old medical tenant that had, I don't know,
they had a big build out.
Yes, 60 patient rooms in it, and it was just a very hard space to lease to another user. So we basically just demoed out the whole back half. We left some of the clinician spaces open because they're basically like offices.
They look like mini offices up front.
Yeah.
So you walk in, there's 4 or 5 mini offices, and then in the back is just a
open warehouse, like 7,000 square feet open warehouse now.
Yeah, it's pretty cool.
Yep.
So we've had good luck leasing this stuff as well. I mean, that's kind of why we're doing it. That's what we're seeing.
Exactly.
The leasing demand. We jump into leasing. We should go through just some of the stuff we're seeing right now. So, piggybacking on that, our flex stuff, that's really, we saw big demand over the summer for that stuff. We've signed a few leases here and there right now, but most of what we have on the flex side is under construction, right? It's not available.
Yeah, and I think that's the key word is number one availability, number 2 move-in ready. So we have several projects that are available but not move-in ready.
Yeah, so it doesn't count.
It doesn't count at all. So the ones that are available and move-in ready lease really, really quickly, and we actually don't keep any inventory of that. So it's really just getting it to that point as quickly as possible and then moving on to the next.
Yeah, we don't have any like really available, move-in ready and available is taken. So like I said, we've got 150,000 square feet that we're demoing out, and a couple months we'll have everything. We'll have that in phases. Our first one will be done in like about a month here on that front, and it should lease pretty darn quickly. Yeah, we can't even really like pre-lease it until it's actually cleared out and ready. Right. No one wants to even look at it. There's no like, oh, I got to go line my space up ahead of time now. They're just like, hey, once it's actually ready, then we'll come look at it.
Yeah, and so we shifted one of our projects in the QOZ up in Charlotte, Graham, we shifted our marketing towards more industrial warehouse users, and we leased our first lease there, which was really exciting, about 3,500 square feet. And talking about moving, it was really just a warehouse, and this woodworking company literally took in and moved in the next day. It was faster than we can even like convert the power over to them or even consider. Really
like, we're ready to go here.
Yeah, they just moved in and we're like, all right, great, let's go. And it ended up being a great deal for both us and the tenant. And that's why we're aggressively looking more at this warehouse flex user more so than office users.
Yeah, office. In certain areas, we have a few deals that are the small office tenants. And we're seeing good leasing momentum, and they're well occupied, and they're there.
Yeah, like 500 square feet to up to like probably 3,000-4,000 is they move in. I mean,
but it's got to be move-in ready. It's got to be ready to go. It can't be like this layout doesn't work. I got to move stuff. It's like this layout works. We'll take it, and we're gonna move in now.
Yeah, we're actually sharing some cubes with those tenants as well, as they need them. We have plenty of cubes to give away.
Have a free cube. Yeah. But. So that's what we're seeing on the flex front, on the office front, on the medical front. We don't have a lot of open medical space. We have one big medical lease we're working on right now, but those are longer, significantly longer leases. That'll probably be like a 9-month leasing process to go from. We have signed LOIs, and now we're going through full budgeting and what does the plan look like for the space, and you're talking like a 10-year lease frame. So that right now will probably take us about a year to get to 9 months to a year to get fully through that.
Right. So yeah, these bigger leases really kind of slow down the process overall, but they're very, very valuable.
Yeah, they're great once you have them, but they are taking significantly longer to get through. Other part of leasing is, the costs of leasing have changed dramatically over the past, call it 36 months.
Yeah.
Even the past quarter. So right now, just kind of idea of where we're at. You're basically going to get a free month of rent for each year of lease. So if you sign a 5-year lease, you can get 5 months of free rent. It's kind of what we're seeing in the market. Our leasing commissions on those leases, they used to be around 3 to 5%, and now they're kind of 5 to 7%. There's been a big
plus first months
plus to first month's rent. Yeah. There's the slowdown of not only leasing, but the slowdown of sales has definitely hit the brokerage community hard on declining revenues, and to kind of make up for some of that, it looks like we're seeing increased fees,
right?
Especially on the leasing side right now. Our transactional side, though, fees are still higher than they were a year ago, right? So those fee charges are definitely going up right now in the current environment. So. TI, most of our stuff is, if we can get it move-in ready, the only really TI that we need to provide is, if most of the time we don't have paint colors that are too far off, but people want to see some paint and they want to see some specific trims that makes the location feel a little bit more them, right? So that's a few dollars. That's not a major TI package. So that's really what we're seeing right now.
Yeah, and in terms of negotiating a lease, what we're finding is that on the TI front, there's not a whole lot of negotiating, right? They want or need what their TI needs are, and they really can't move from that. And really, the only thing they can really trade in return for that is term. The rent ends up being kind of a fixed market rate number, so they're willing to give, instead of 5 years, maybe they'll give 7 years, or maybe they'll give 10 years. But what we're not seeing is really any softening on the TI demands, and we're not really seeing a whole lot of give and take on the rent either.
Yeah. But overall leasing, there's deals out there.
Mm-hmm. Oh, there's plenty of tenants.
There's plenty of tenants out there, and yes, everything is probably harder right now. Yeah. So just means you got to
Work harder.
Get to work a little bit harder. So
Exactly.
that's our wrap up for right now. We're gonna get back to work and go work on getting some leases done.
Yeah,
Thanks for watching, everyone. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.